And using delegated proof of stake, we can process 2,000 plus transactions per second, block finality within 2 seconds, and nearly zero gas fees. And if your project is ESG aligned, I mean, XDC is perfect for you because the entire network only consumes 7,400 kilowatt hour per year. And yeah, let's take a look at the partners that we have or the regulatory ready feature that we have. So XDC network is just one of the few networks that is compliant with the MLETR. I know one of you guys will be covering that, but as a short summary with that is you can tokenize receivables and electronic bill of lading, making for SMEs accessible to capital and of course faster settlements. Okay. And also one of the other advantage of XDC network is it's one of the few networks that is embedded with the ISO 222 messaging, which the banks is which the standard bank use. So this means that using XDC network, we can process seamless IBAN to IBAN transactions using XDC asset and other XRC20 assets. So you see, combining all these features and the regulatory ready feature, this is why institutions trust XDC network. So we have ArchXX, Securitize, TradeTech, ITFA, and a lot of more, even Fireblocks. There's a lot of the partners that we have. And in fact, we are backed by the SBI Holdings. It's a huge conglomerate in Japan. So we have this joint venture with them called XDC SBI APAC. So yes, and the last one that I want to point as how we nurture our ecosystem. So in XDC network, we do not just nurture the ecosystem, we invest in them. So I've seen familiar faces. So we partner ourselves with reputable accelerators to run cohorts for us. But since this is more about RWAs and payments, I want to focus on these partners that we have, such as Plug and Play Silicon Valley and Plug and Play APAC. In fact, this Friday, we have a demo day in partners with Plug and Play Silicon Valley for an XDC demo day, which is focusing on RWA. I hope I can see you guys there, find out which projects XDC is investing to. And with Plug and Play APAC, we have opened another cohort and focusing on the payments vertical. So yes, if you have any question about XDC network or these investment programs, please feel free to network with me later on or other team members of XDC. Thank you guys. You guys are awesome.
Thank you, Rebecca. Indeed, lots of layer ones are emerging in the market, and blockchain use cases are emerging in the market. And I must say XDC network is particularly open to partnerships and interoperability. The more I see, and in particular with the emergence of stablecoins, I see layer one more and more like in Web3 environment, like a website in the Web2 environment. You have websites interacting with each other in the Web2 environment, because one click will lead to Google Analytics or to other websites for tracking, for billing, for measuring activity. And on the in the Web3 world, those chains will compete less and less and will interact more and more because each of those will be highly specialized on particular use cases. So that's a bit of change of perspective, because years ago we thought one chain will compete with another chain. I really changed my mind, in particular with the emergence of stablecoins, where stablecoins can be natively issued on a particular chain, but at the end of the day, the key is to distribute the liquidity to the transactions operated on any type of chain, or not any type of layer one, which is why indeed the stablecoin use case is another example where interoperability and cooperation amongst chains will be essential. We'll come back to those points, but I thought that was wanted to share this perspective, which is quite personal, and as often I always want to hear from those who don't agree, because it's always a good learning opportunity to think about indeed at other perspectives that you might have. But we'll discuss that during the panels. We will start with a keynote by Andrea Stasi, an academic who will tell us about tokenization, and then indeed go into 3 different panels, one on origination, one on stablecoin, and one on the tokenized investment products, really following the transaction lifecycle, before going deeper into the legal constructs and the side of tokenization. After the sessions, we will invite you to a buffet networking time, so we should have ample time for networking. If you have any special requirements, don't hesitate to talk to the team. There is ample water and coffee also. Please help yourself. Don't hesitate or ask for help. So with this, I'd like to invite Andrea to the stage for your keynote.
Thank you. Thank you, Andre. Good afternoon. Hi, everyone. I'm Andrea Stazzi, as Andre mentioned. I'm an academic, but wait, let me start with this. Don't run out of the room. I try not to be too boring. It's true that I have to be a keynote here, and so to be as inclusive as possible, because we have from leading experts in the field to young fan of blockchain and disruption by digital. But I try to do that in a not too boring way as an hostile academic to avoid being disrupted as many things in the realm of innovative technologies, blockchain, crypto, and so on and so forth. So, tokenization. Tokenization is, as most of us know, the process of generating and recording a digital representation of assets on a programmable platform. Why it's key and it's changing our lives? Because it is increasingly changing the way financial services work, and in this way is marking the next big step, basically, in the evolution of our monetary system. Recently, reports in particular from the Bank of International Settlements compare tokenization to past shifts like moving from physical coins to ledger entries managed by trusted institutions, and then from paper to electronic ledgers, which are leading to today's form of digital cash. Various entities, as we know, we have representatives here within the financial industry, are engaging in the tokenization of diverse assets, and some banks are even proactively developing their in-house blockchain capabilities to facilitate tokenization application. So, what's the potential here? Pretty clear: significantly improve the operation of banks in the realm of trade finance. Could make, for example, the origination and distribution of trade finance more efficient for banks, and also enhancing their capital efficiency. And for companies that adopt trade tokenization, it could expand the reach of supply chain finance to a wider network of suppliers, or we have also use cases here, reduce the risks by utilizing tokenized bills of lading and tokenized deposits, for example. So this is in general about the benefits. At the same time, considering the various options for use of tokenization, we have also various definitions used by various regulatory and governmental bodies that are tailored to their specific objectives. A central bank may define a digital asset by its function as a currency, or a security regulator may define it as a security, or a tax authority as something limited to tax implication. We have every regulator seems to run after tokenization and blockchain disruption. So we have to bear in mind that even in this environment, there is a sort of competition among authorities, and it's important also to see that there are promising and important regulatory developments out there in various countries that are making clarity about the definition of digital cash, in particular about stable coins. Recording digital ledger entries using distributed ledger technology is particularly important to advance market infrastructure for two basic reasons. One, the ledger is, as we know, distributed. The second, the added value, is that each entry on a tokenized digital ledger technology is rich in data. And so we have both the asset information as with the usual assets, but we also have embedded the rules governing how the asset can be used. And so the asset rules already in that. So basically, again, the Bank for International Settlements highlighted the transformative power of digital distributed ledger technology by contrasting it with the previous step, that are the traditional electronic ledger systems. That's how currently each financial institution still keeps its own separate ledger and communicates with others through external messaging system. And this is a fragmented approach that can be, surpassed by a unified layer that enables automation and seamless integration and reduces the need for manual intervention and reconciliations afterwards. Currently, there is not yet a worldwide agreement on how to regulate the issuance, custody, and trading of digital tokens. Different countries have taken various paths about that. Let's start from the principle. The key principle in our financial system, in this realm, is the singleness of money. So what does it mean? Basically that when money is exchanged, its value doesn't fluctuate because of exchange rates between different forms of money, depending on whether it's privately issued, like, for example, in bank deposits, or publicly issued, like in digital cash, in physical cash. And so currently there are three main categories of digital cash instruments that are trying to provide solutions in that perspective. We have tokenized deposits. We have the central bank digital currencies, the latest news about the intention of here in the Emirates to have a digital dirham, for example, and we have the stable coins. So let's start from tokenized deposit. When a bank issues a token to a customer representing a traditional deposit, this creates a tokenized deposit with the same regulations as traditional deposit, and with the feature that is, on one hand, that they carry less credit risk because they are issued by regulated banks, but they also have limited liquidity because they represent basically a reproduction of a traditional deposit. And so essentially, tokenized deposits mirror the current financial system, where, yes, the intermediaries play a role, but they could enable faster and near instantaneous settlement if banks can also settle wholesale payments using a central bank digital currency or another fast settlement method. And so what the second option? What is a central bank digital currency then? It's a digital version of a country's official currency that's issued by government. There are basically, to make a long story short, two ways in which a central bank digital currency can be implemented. One is for use by the general public, so the retail digital currency, and the other is for use by financial institutions. Let's get to the third and at the moment most promising, it seems, option for the digital cash. Stable coins. Stable coins that are backed by traditional currencies function like basically physical bearer documents, meaning whoever holds the stable coin has a right to claim an equivalent value from the issuer's reserve funds. Their value, at the same time, can theoretically be threatened by the risk that the issuing company might not be able to meet its obligation and that's the basis of the regulations about that. And this risk has undermined their ability to function as money according to the principle of the singleness of money that I mentioned earlier. But in July 2023, the Financial Stability Board issued a report with a recommendation for global regulators on how to manage, provide rules for stablecoins. So basically, they required, the Financial Stability Board required 7 basic rules. First, same activity, same risk, same rules. Second, strong governance. Third, appropriate risk management, especially regarding reserves that are the guarantee, obviously. Fourth, operational resilience. Fifth, anti-money laundering. Sixth, cybersecurity measures. And seventh, clear and transparent information about how the stablecoin operates. So, afterwards, after these guidelines from the Financial Stability Board, several countries are developing laws and regulations accordingly. Let's have a look at the international framework in comparative law. So, United States, first of all. In the United States, there isn't yet one single federal law that covers all aspects of stablecoins. They are regulated at the state level, and the federal government only regulates them for the purpose of preventing financial crimes. Most states require stablecoin issuers to register as money transmitters, while a few states have developed more detailed and comprehensive regulatory approaches. To remedy this fragmentation, both the Senate and the House of Representatives have been working since years on stablecoin bills. In the previous Congress, under the Biden president, were several attempts, and now the Trump administration is supporting strongly legislative efforts related to cryptocurrencies and stablecoins. As we all know, probably, soon after taking office, President Trump issued the famous executive order with the aim of enhancing American leadership in the realm of digital financial technology and establishing the crypto and AI czar, David Sachs, who also described stablecoin legislation to be introduced regarding market structure as an administration priority. After that, various draft legislations regarding stablecoins were introduced, both in the Senate and in the House. In the Senate, the so-called Genius Act, and in the House, Genius stands for Guiding and Establishing National Innovation for U.S. Stablecoins Act. And in the House, the Stable Act, Stable Transparency and Accountability for a Better Ledger Economy Act. In the last month and a half, many things happened regarding these bills. On March 13th, the Senate Banking Committee approved the Genius Act in record time. President Trump took the seat on January 20th, so 2 months basically. Stablecoins, according to the Genius Act, could be issued by a permitted payment stablecoin issuer, which could be either a subsidiary of an insured depository institution, or an uninsured depository institution, or a non-bank entity. And depending on the level of, let's say, guarantees that these issues provide, the legislation would be, and so the competence would be federal or at state level. On April the 2nd, also the House of Representatives Financial Services Committee approved the Stable Act at the same time, basically after less than 20 days. And according to the Stable Act, after a 2-year transition period, only permitted payment stablecoin issues will be authorized to issue stablecoins in the US. Again, 3 categories: subsidiaries of insured depository institution, federally qualified non-banks, and state-regulated entities that pass a federal standard test. Stablecoin issuers are financial institutions, and therefore, according to the Bank Secrecy Act of the US, full anti-money laundering compliance applies. After the application in the committees, then both the Genius Act and the Stable Act will now move respectively to the full Senate and the full House of Representatives for final approval, theoretically. They have some differences, and so let's see if ongoing efforts, political efforts to bridge them and to find one common version of the bills are successful or not. Otherwise, this bridge must, and the discrepancies they still have need to be resolved. For instance, to name one, the Stable Act does not specify a particular amount of outstanding payments, stablecoin issuance, that would necessitate an issuer, while the Genius Act includes a $10 billion threshold for such a transition. The 2 major questions for the upcoming political discussion in the Senate and in the House are basically whether authority will be split between state and federal authorities, and the other is whether stablecoins should be permitted to bear interest very hard, because basically nowhere this is allowed. Last but not least, on April 4th, the SEX, the SEX division of corporate finance, also issued a statement indicating that the stable coins are not securities. So great news. And therefore, they do not need to be registered with the Commission. These, and the SEC also specified that this is true for covered stable coins that are the one that are designed and marketed for use as a means of making payments, transmitting money, or storing value, and are backed by low-risk, highly liquid assets to ensure issuers can meet redemption demands. So, key takeaways from the statement are that, first, interest-bearing stablecoins could turn what is now, according to SEC, a consumer product, so not a security, into an investment product, so a security. Second, stablecoin issuers might not need to register as investment companies, as long as the assets backing the stablecoin are USD or other assets that are considered low risk and readily liquid. What about Europe, land of rules? In the European Union, the market, the MiCA, so the Markets in Crypto Asset Regulation, which was adopted in June 2023, provides a detailed regulation for stablecoins. They are classified as either asset reference tokens, that are those designed to hold a stable value by referencing various fiat currencies, commodities, or other crypto assets, or electronic money, so e-money tokens, that are designed to hold a stable value referred to one single fiat currency. E-money tokens, obviously, are likely to be the most important type for institutional tokenized asset markets. And issuers of both the asset reference tokens and e-money tokens must maintain reserves that fully back the stablecoins. And also the stablecoins, according to MiCA, must be redeemable at their original value in the currency they reference at any time. Only credit institutions and authorized electronic money institutions can issue e-money tokens. Staying in Europe, last but not least in the region, in the United Kingdom, the regulatory framework is split within three separate authorities: Bank of England, Financial Conduct Authority, and Prudential Regulatory Authority. And basically, there is a distinction between systemic and non-systemic stablecoin that can impact or not the whole financial system. And issuers of systemic stablecoins would be regulated by Bank of England for the soundness of the financial soundness, and by the FCA for how they conduct, they behave in managing business, while the less impactful stablecoins, the non-systemic, would be regulated just by the FCA for both conduct and financial soundness. The framework, regulatory framework in the UK, includes, again, rules for all stablecoins regarding reserve requirements, capital requirements, redemption processes, and whether interest can be paid. So, in a nutshell, reserves must be held in very liquid, high-quality assets, with the Bank of England preferring central bank deposit. Redemptions must be at face value. FCA next business day. Bank of England requires same-day payment. And both regimes prohibit paying interest on stablecoin. Finally, to finish the comparative overview, Asia. Singapore in 2022 has published its regulatory approach, not yet implemented with the operative guidelines yet, but it's quite similar to regulations that I mentioned earlier. So the need to maintain reserves of highly liquid and high quality assets with a value that is equal to the total value of stable coins, and the need to have redemption promptly at fair value. And stablecoin issuers that are not banks will need to hold a major payment institution license, or a standard one if they have less than 5 million SGD, Singapore dollars, in circulation. And second, maintain a minimum amount of capital, and third, restrict their activities to a specific set of allowed activities. In Japan as well, we have a framework for regulation of stablecoins since 2023. Issuers are limited to specific subjects that are licensed banks, registered money transfer agents, and trust companies that have also registered as electronic payment instrument service providers, and that need to match the amount of tokens they have in circulation one-to-one with cash deposits in bank accounts. But a most recent bill just approved in March and passed to the national parliament, national diet, basically would provide more flexibility regarding the type of assets, including certain Japanese and US government bonds with a short term of maturity, 3 months or less. What about, obviously, UAE? Stablecoin are regulated through the Central Bank of the UAE's Payment Token Services Regulation that establishes a framework for regulating stablecoin-related services, including issuance, custody, transfer, and conversion of payment tokens. And the regulation prohibits the promotion of services regarding algorithmic stablecoins, privacy tokens, or other means of payment that are not in dirham or a foreign currency. To operate in the UAE, the issuers, custodians, and conversion providers of stablecoins must obtain a license or registration for the central bank. Issuers must maintain sufficient fiat asset reserves in a dedicated UAE licensed bank account, which must be highly liquid, protected from risk and creditors, and audited monthly by an external entity. Merchants will have until July 2025 to obtain licenses and stop accepting non-dirham or foreign currency stablecoins and other cryptocurrencies. And so it's expected that over the next few months, until the end of the transition period, several dirham and foreign currency stablecoins will be licensed and registered. And lastly, as I mentioned earlier, the central bank has published its strategy for the digital dirham to address the friction of domestic payments and move toward a cashless society. And I come finally to the conclusion. So tokenization is increasingly seen as a way to improve significantly the efficiency and reliability of our financial markets, but the issue is to find a way to comply with the singleness of money concept. So we have, on one hand, great developments in the realm of regulation of stablecoins in many countries, as I tried to mention here. On the other hand, another very important development is the public-private partnership. Let me mention one example. In April 2024, the Bank for International Settlements revealed Project Agora, that is a joint effort involving 7 central banks and numerous private financial firms. This project aims to investigate how digital representation of commercial bank deposits could be smoothly connected with digital forms of central bank money. The goal, obviously, is exactly to improve how cross-border payment function. This project seeks to determine how a combined platform that includes both central bank digital currencies and tokenized commercial bank deposits could make business and regulatory processes in international bank payment systems more efficient, and the anticipated benefits could be faster and cheaper transactions, greater transparency in payments, and reduced risk for banks. Thus, basically, we have 2 work streams. One, stablecoins, brave new world, great developments, finally, even in the regulatory environment. And the other is the mix between tokenized deposits and central bank digital currencies, thanks to joint public-private efforts. These ongoing efforts to create, on one side, the regulatory frameworks for stable coins, and on the other, interesting option of a mix between digital currencies backed by central banks and tokenized deposit seem finally to show the way and to hold the key for unlocking the full transformative potential of tokenizing financial infrastructure. Thank you.
Thank you, Andrea. And indeed, in the tech world I'm living in, this is the most interesting side of the story, is the regulators following the tech developments in order to align the national laws with those opportunities they have. Because besides the fact they want to help the private market to take advantage of those innovations that we will discuss in the next 3 panels, they also want to attract the talent onto their soil, like they're doing here very well, actually, in the UAE, but this is being noticed. And that's why also there is maybe a peer pressure between regulators to adopt and to catch up with those technologies and not only helping the market, but really being at the forefront of those legal and regulatory developments. Thanks a lot, Andrea. I hope you can stay with us, because I'm sure there will be questions. We have no time now because we have 3 panels to go through, but clearly that's the way to go, focusing on the alignment of, and work of legal and tech, and working with the regulators. Thanks a lot. Moving on. We're going to start our transaction journey, focusing on the origination side. So I'd like to invite my 3 panelists to the stage, Venkatesh, Ala, Alessandro, and Mahesh, focusing on origination developments. We have a seat for everyone. Yes, even for me. Very good. So indeed, first panel, we looking at the origination, and again, as I like to tell some fintechs I'm advising, origination is not between the corporate and the bank. Origination is also in the supply chain management world, in the physical world, where transactions emerge and where agreements are sealed between buyers and sellers. Which is why I'd like to start with Ala to tell us, of course, about yourself, but also about Done and what is Done doing at a tokenization in financial services event.
Hello everyone, good afternoon. My name is Ala Papaika. I have experience for me now 19 years in corporate finance, and lately 3 years now I am deeply engaged with the trade finance. And here I am pleased to present Done that has now experience from 2019 internationally, and has a Swiss-based headquarters. So Done is a supply chain management and supply chain finance provider that facilitate and actually originate the transaction flows. So we have orders from our clients, and then we place this order directly to manufacturers, and there we act as a sole buyer. So we have direct contracts with the manufacturers. And doing these transactions, we are not only buying these goods and transfer them, we control the quality of the goods. We are in charge of transportation and logistic processes. We are managing the custom clearance processes, and as well as inventory management. So we provide this service as well. And we also facilitate, and the main thing, we intermediate the payments. So that's how we secure all the transaction, because we are holding it and keep the eye on all steps of this transaction. Since we started our business as a logistic company, and now we have onboarded 190 professionals, experts. We have very deep expertise in logistic and supply chain management. So going to tokenization issues, how we implement it and how we work with this. I'm happy to share this experience from the corporate side. Since we are growing, by the way, about the growth, how big we are now, we ended up this year, 2024, with a turnover of $200 million. And to understand that figure, last year, last full year, 2023, it was only $75 million. So we doubled in size. And obviously, as we are growing, we are discovering new financing pools and looking for funders. And yes, we succeeded here as well. We have several funders. It's no bank lenders, alternative lenders, I can even say. And with those lenders, we had opportunity to launch these tokenization issues and digital negotiable instruments, all that things. And we've been working with this for a year now, successfully implementing all these instruments. How we work. Mainly we are using digital promissory notes, and we digitize these notes by AGO technology, which is compliant with MLETR, as I know. And that gives us opportunity to facilitate this transaction for the lender, because it's secure for them. And yes, that's how we use tokenization in our regular business practice.
Thank you, Alain. Very good. We'll come back to you for more details. I'm sure you have more to share. I'd like to move now to one of our non-bank originators here with BlockPeer. Venkatesh, can you tell us about BlockPeer's focus and what you're doing?
Thank you. Thank you, Andrea, for organizing such a wonderful event. Thank you to the XDC. So BlockPeer is let me tell a quick overview of BlockPeer. BlockPeer is a modular ERP or TMS platform. So we have like a multi-modular, starting from the typical Web2 accounting, and then like a wallet infrastructure with the MPC wallets, and then multi-sig wallets. And then we have a module to do the RWA tokenization for various trade assets such as EBL, EPNs, and then another module for trade finance marketplace. Our platform services a comprehensive single-stop solution for the B2B corporates like a Dome or other parties who can simply tokenize, because tokenize is a fancy word in a sense, like when it comes to when we are going to the typical Web2 company, then when we are showing issue a tokenized EPN or something like that. So where do they go? They go to the another platform. Someone like they go to the different platform. We embed everything into the single holistic platform. You are having an invoice, you are having a future payable. You can issue various tokenized trade assets such as electronic promissory notes, the EBL, electronic invoices, and much more documents. And then you can issue to the lenders. So lenders can log in, and then like they can find those documents, and then they can do the payments, they can do the financing. And then now we are also coming up with the BlockPeer Pay as a off-ramp and on-ramp module. One thing like we would like to add is like nowadays the stablecoin based payments are moving with the objective of move the payments at the speed of emails. So for that to happen, the document should be able to move at the speed of emails. You cannot issue a stablecoin based payments and then waiting for a courier electronic promissory note or courier promissory note to arrive. So that such kind of digital electronic promissory notes using MLATR, which are kind of legally valid, which is complementing the use case for our B2B companies that issue the document and get paid faster. So the end user, our users are seeing only the benefit. How can I get financing sooner? So this is the value proposition we are offering to our B2B corporates in terms of originating digital trade documents.
Thank you. Venkatesh, Mahesh, you're also acting as a in the origination space. Tell us about 1 to 9 knots and how you position yourself.
Yeah, sure. Good afternoon, everyone. This is Mahesh here. I come from 1 to 9 knots. Just to emphasize, 1.29 stands for Singapore, so I'm from Singapore. And the reason why we started out origination, because we are basically a corporate venture spin-off of a parent company, which is a large global energy trading company based out of Singapore. We've been doing almost like $5 to $10 billion worth of transactions. The first fundamental problem over the last decade, we understand working with all the banks, especially in industry like marine fuels, which is like sending fuels to large vessels, which actually move all the merchandise and all the goods across. 90% of that happens because of the fuel which goes into these vessels. We predominantly actually provide these fuels to these vessels. It's a very large industry. It's a $200 billion industry. And when you're talking about such large frequency, what is extremely important to bankers is origination, right? And today morning also, along with a colleague, we were right here with a very leading bank. The first question is the volume and the origination. Where is it going to come from? And if you look at all the banks who are predominantly exited trade finance banks, it's going towards the direction of non-bank originators like us. And why will big banks trust us? That's a fundamental question, right? And if you don't do your job well, these assets are not going to be banked, neither going to be tokenized, because they're going to fall, because you need to manage the risk behind it. We, as non-bank originators, are extremely industry focused, first and foremost. We really understand the underlying business before we actually originate, without which what promises you're doing to large bankers goes flat. So first, you need to understand the business risk. And that is extremely important as originators. Surprisingly, our mission is also to be the most trusted originator. I'm adding this word right in the phone. You just don't have to be an originator. You need to be trusted originator for the capital to flow. And what does trust mean in origination in a very large industries? It's about how you go about doing it. I was keenly listening to your speech. How do you manage the transaction? How do you manage the credit? How do you actually manage to take the exposure on these assets? That's what we as non-bank originator do it. And the more the trade finance portfolios are moving out of the bank, it means it's moving in the hands of more expensive financing. And when you look at these large trade businesses, expensive financing means trade is going to get higher pricing. So it needs to be competitive. And as an originator, we need to know where the steps are, where the risks are. As a non-bank originator, that's exactly what we handle. And we do it in a very systematic OTT platform. So we also have a tech and a lending company in that way. So we manage the transaction on the origination side. We manage the distribution on the funding side. So that's what we do. And it's very clear. And maybe let me also say it. Moving forward, I think the banks might move more documents than the capital. And it might be the private players who might move more capital and less documents, because the documents will get digitized in a different form. And as a result, as non-bank originators, we need to be extremely connected to platforms. So we also see as non-bank originator, we might be meta-connected, platforms to platforms speaking so much. So that's who we are.
Thank you, Mahesh. So we had a corporate with Anna, 2 non-bank originators, and then we have Toknar, which is yet another type of service provider, and you're referring to embedded lending. So tell us about how you apply embedded lending with Toknar.
Thank you, Andre, and everyone. Alex here from Tokenized, co-founder and board member. What's Tokenized? We basically are a platform that matches the request for liquidity from companies, often small and medium providers and suppliers to bigger companies, with liquidity providers, normally non-bank liquidity providers. At the moment, we are mainly focused on institutional money, but through tokenization, obviously, this can involve potentially retail investors on the liquidity side. Now, you asked me, Andre, specifically about embedded supply chain finance. By that, what we mean is that our solution is not just an external platform that can be accessed by people looking for liquidity and non-bank liquidity providers, but can be embedded in a white label within the systems of often the actual debtor. So let's say a bigger company that wants to provide through our network of non-bank liquidity provider immediate and seamless access to liquidity within their own ecosystem. So having our platform within the ecosystem of their own, that process is actually completely under their control and strengthen the relationship that the suppliers and providers have with them as a client, because obviously ease off some of the burden of their cash flow and also can help them to negotiate better terms with their own suppliers and provider, and the same can do the debtor, our client. Now, specifically then to embedded supply chain finance, I think it's important if you compare it to what can be an external platform provider, which simply treats every party as a user effectively of their own platform. We need to be extremely aware of the particular needs of the process flow of our customer. What do I mean by that? That can be often counterintuitive. For example, we have a meat exporter that's coming to us with an unusual problem, because effectively the liquidity issues are on the client side. What do I mean by that? In the beef and meat business, often the producers ask for the payment to be completely upfront, or at least a big chunk of the payment to be provided upfront, which means that they, as suppliers, they actually don't have cash flow shortcoming waiting for the delivery and the invoice life cycle for what the goods they deliver. Now, unfortunately, by asking the clients to pay upfront, the burden is shifted on the other side of the transaction. The exporter, in the case, asks us to help them provide a buy now, pay later credit facility to the clients. That's counterintuitive, but effectively, by supporting the clients on that side, you're financing the supply chain on the other side. Again, that's something that a traditional lending platform for trade finance and invoice financing will see as like a shift on the workflow, but being embedded in their system, we can still enable to do that. And in the case, not only they strengthen the relationship and loyalty with the suppliers and providers on the left side, let's say, of the platform, but the same happens with their own client base, because it's easier to buy from them from a cash flow perspective than any of other competitors. I close by saying that by working with us, they forecast to more than double their turnover within the short term by expanding customer base, including, let's say, incrementing the average transaction volume by customer, and also, of course, there's a loyalty element for the long term.
Yeah. Thank you, Alex. I mean, there is a lot in those four stories, but it's all about also moving beyond what the banks have done very well over the last 25 years in terms of supply chain finance, but which has always been anchored to an investment grade buyer. You have a Carrefour or Tesco or one of those large buyers in retail, or Vodafone, buying from lots of suppliers, and then supply chain finance through the banks will all aim at financing the SME suppliers, and the risk is on the large buyer. So that is easy for the large banks because the risk is very low. When you're moving indeed, in your example with the meat exporter, understand, the business is SME to SME. There is no investment grade buyer necessarily to rely on. So this is real supply chain finance in my SME financing, in my view, because the two ends, and I think that applies to ALA as well, the two ends, the supplier and the buyer, are SMEs below sub-investment grade, and the banks have a hard time to enter that space because they want to anchor an investment grade corporate. So a huge market opportunity here to introduce indeed tokenized products such as a promissory note, which can then be insured possibly by a bank still, or by a credit insurer, or by multilateral development, or by an asset manager willing to expand its role from liquidity to risk. So this whole space of supply chain finance is indeed, as Alex says, moving from banking to the corporate space, getting closer, getting a partnership with the corporates involved in the supply chains, and expanding beyond the large buyer to small supplier typology we have seen over the last 20 years, and really moving into SME to SME. And there are other, great insights in terms of selling more, which is always the goal of SME exporters, and relaxing the payment terms in order to be selling more. So Alan, you have been using some, can you tell us more about the benefits you see of tokenizing promissory notes? You have been using a specific vendor for this. Can you dig deeper into that?
Yeah, sure. Andrea, Alexandra, as you said, really all these instruments, tokenized instruments, are indeed beneficial for business, and we can see that, and for SMEs, businesses, it's really beneficial. From our side as a corporate, as we originate all these transactions, the main key, core point is to provide the maximum security for potential funder and for funder, even though we are using these digital instruments that secure them as well. But for us, it's main point to design the transaction flow that way, so that would be interesting and secure for potential funder. And how we do that in GAN, we do that through the legal framework, of contractual legal framework, and also by really tough selection criteria for our clients and the clients as well. And we are doing that also through the fact that we are holding the title of the goods, and we keep these goods at our balance sheet, at our warehouse, bonded warehouse for the second. And so we use these goods as a collateral as well. So for funder, that is additional kind of a security in terms of that non-payment risks. And going back to tokenization and the transactions that we had, by the way, we were talking about crypto as well. We had this practice as well. We launched a project, and we found an alternative lender who agreed to fund us, and we were doing that through stable coins. By the way, using XDC network. So everything was working perfectly, and that is another option that we used. And again, we were doing that through digitized promissory note. So how it works? We just apply for some funding. We provide the invoice to the platform. We digitize this invoice, and we digitize this promissory note as well. And we transfer the ownership on these promissory notes, and we just have this payment from the funder directly to the Chinese supplier, let's say, right? So we are not keeping this money into our accounts. We're not doing with them nothing. They go directly to the supplier. That's how it works. And then when the day comes, we just pay back to our funder, whether through platform, whether directly to their bank account, just by the regular bank transfer. But the key point is just this promissory note that gives like additional security to our funder, and we transfer the ownership of this promissory note to our funder. That's how we facilitate the transaction.
So you have started to use tokenization for the contract, the commitment to pay, the promissory note.
Yes.
But you could also use the tokenization for the payment. You have done it already with XDC Trade Network, a platform.
Yes.
So the stablecoin story, the next panel, will be of interest to you as well.
Of course. So it's workable in supply chain management business, and it's pliable, and it's a great opportunity for business.
Good, thank you. Anna, in the interest of time, I will ask Venkatesh, what are your expectations with regards to the partners you might work today with or in the future with? What kind of partners are you looking to grow your use of tokenization?
So when it comes to our part of the tokenization, we are mainly enabling the commodity trading companies to tokenize or digitalize the various shipping documents, including the invoices, and then bill of lading, BDNs, and then packing list, and then electronic promissory notes for the funding and everything. When it comes to the collaboration from the partners, we are looking for a collaborating effort from the industry governing bodies. There has been a good initiative coming from ICC DSI to provide some sort of this standards of the documents which can be intercommunicated among the different parties. And then there has been a lot of efforts are happening for the EBLs, this interoperability, which is like much more helping things. So when it comes to the partners, it would be better if we are having a collaborative effort among various shipping bodies and then trading bodies across the region that can expedite the adoption of the digital trade documents and then subsequently stablecoin based funding.
Okay. On your side, Mahesh, how do you see yourself partnering if needed, and what kind of partners are you looking for to benefit from the tokenization across multiple use cases?
Sure. For us, since this has been an age-old industry for more than 500, 600 odd years, it still works in a different form. For us, tokenization, obviously, the two dominant parts. But first, we need to understand what is happening in the asset class. Right? We are trying to generate asset class which are investment grade, which is exactly reverse. Right? So we are trying to take an asset class and make it investment grade. As we as originator, it's our role to ensure how we structure these assets and become investment grade. It's surprisingly interesting. The waterfall works reverse. The big guys are wanting risk spreads, are going after different assets. The risky guys wants them to be stable because the liquidity is high. It's a very complex dilemma which happens between the money here. And we as originator are trying to make it institutional grade asset class. So once you understand what is a primary asset class, the derivatives becomes interesting, because one asset can throw multiple derivatives for it, on which one obviously is a payment-based tokens, asset-based tokens. But trade is very long. Once you understand where the capital chokes, you start understanding you can even tokenize corporate guarantees and personal guarantees. When you start looking at insurance, the insurance risk capacity of the banks, which is actually buying, becomes a choking point on your trade assets. Then there you become a tokenizing of insurance. Your capacity becomes interesting. So you're not only looking at one layer of where you should tokenize, because assets for liquidity is great, but there's a lot more derivatives on which we can tokenize. This is where our partnerships could be interesting. We could look at tokenized credit insurance, we could look at tokenized guarantees, we could look at tokenized collaterals, right? those are the areas on which we are looking to build an ecosystem of tokenization. It's not just the underlying asset on which we are originating. So it's like 6-7 fundamental derivatives on which we can tokenize.
Yeah, so using tokenization to expand capacity, risk, liquidity capacity.
Exactly.
So, and involving players through asset-backed finance practices or asset-backed securitization, which is the topic of our third panel.
Yeah.
So interesting to see that although you're all focused on origination, you're not really only focusing on using tokenization in the origination step, but also further along
That's just the start.
the transaction.
And there's enough liquidity there, but there's a lot more markets, derivatives to look at.
Yeah. Okay. Very good, Alex. On your side, you're also building Tokenar with tokenization by design, I would say, if you agree. How do you see indeed potentially your partnership with others, but also expectation from policymakers? What do you expect from policymakers to scale the adoption of tokenized instruments?
Right, yeah, good question. First of all, when we look at our partners, obviously we want common vision that we pursue. We really believe that the future in terms of trade finance lending, receivable finance lending is digital lending. And tokenization is one of the key technologies that will enable that. Now, we also would like the governments, the regulators, to see it the way we do by partnering up with private funds and companies that have that vision. What I mean by that, if you look at the consequences of what we do, through tokenization, artificial intelligence, automations, all form of automations, we simplify and make more cost-effective and faster all the servicing of purchase agreements of trade receivables, for example, invoice factoring, or all those processes. That makes it easier for SME to access capital in a more efficient, cost-effective, faster way, which means companies have more potential to grow. That, at the very least, has a positive cascade effect on the global GDP. If there was a harmonization of regulation like the one people mentioned, like the model law for electronic transferable records, that would be easier for us to make it easier for these companies to grow. So there is a cascade effect on global GDP that on turns has a very positive cascade effect on society, lifting up SMEs and obviously the people affected by that growth. So I think the mindset has to shift from how we regulate to make sure that things don't go south, let's say from how do we sustain this without systemic risk to the financial system or fraud risk to the end user, to also how we foster this for literally global growth.
Thank you. In the interest of time, we have to stop here. But thanks a lot, Venkatesh, Mahesh, Alain, and Alex, for your insights. And I hope you can also stay with us because you might have questions from the audience in the next 2 hours. So hopefully we'll see you at the buffet as well. Thank you.
Thank you.
Moving on, I'd like to welcome our second panel team with Billy, Sybil, Ross Edwards, Santosh, Abdullah Kanu, and Ashwin Naid. Please join us. And this time I will need to use a separate chair. So we have another great panel team here with very different institutions. So I'd like to ask each of them to introduce themselves. Maybe we start with Ashwin.
Hi, Ashwin here. I work with McKinsey & Company. I'm an associate partner and also lead the Web3 practice regionally. Very excited to be here and look forward to the discussion.
Thank you.
Hi, good evening, everyone. My name is Santosh, and I head payments for XDC.
Hey, everyone. I'm Ross Edwards. I am a Senior Director for Global Financial Institutions with Ripple, focused on stablecoins and tokenization in particular.
Hi everyone, thanks for having me. I'm Abdel Makano, co-founder and co-CEO of ERP Digital. It's a digital asset focused financial services firm. Looking forward to having a constructive conversation.
I am Phyllis Seabell. I am the Executive Director of the XDC Foundation, and we are focused on tokenization of assets, as we've been talking about here today.
Yeah, I have one. Thank you. Why are we adding the stablecoin topic in a trade-focused event? Is because in trade, we're moving money all the time, but in trade, we're taking risks on money being moved. Whereas in pure payments business, institutions are not necessarily taking huge risks on. There are always some risks, of course, but certainly not credit risks on moving money, because in payments, we debit before we credit. In trade, we credit, and then hopefully we hope to get the money back through debit. So that's a change the way I explain why to my payments colleagues at Swift why trade is different, but very similar. Also in trade, we completely depend on the ability to move money. And as we do that, we are taking exposure, and we charge more for transactions than our payments colleague can do on the payment side in terms of basis points. So this is just some context. So if stable coins bring the promise to move money faster and cheaper with more transparency and programmability, then those stable coins innovations certainly will have an important positive impact on the global trade ecosystems, banks, alternative lenders, embedded providers, supply chain finance providers, and asset managers, possibly also to a certain extent to credit insurers. So this is a reason why the stablecoin topic, although very much a payment discussion, is key for the trade ecosystems. And I've brought this topic within the International Trade and Forfeiting Association, and also within the TFD initiative, as it is relevant for incumbents and new entrants. But as usual, my 20-year experience in bringing innovations to large banks, I know the early adopters will often be the new entrants, the non-bank entrants, which are more agile and more attractive, and also have, because of their smaller size, have more agility to take advantage of those innovations. But surely I've seen great developments in terms of large banks announcing their Bank of America in January at the World Economic Forum, announcing their intention, once the regulators allow for it, to launch their own stablecoin. So there is great buzz and more than buzz around both sides of the industry, the new entrants and the incumbents, about stablecoins. Now, let's dig deeper, because when we talk about stablecoins, we have new providers getting into the picture, which is why we have ARP Digital, Ripple, and others. So Abdullah, let's start with you and tell us about ARP Digital and what is your role in the adoption of stablecoins by the industry? Could be wholesale or retail.
So ARP Digital, we serve as a critical infrastructure in this role. We do the on and off ramping. So we'll bridge the worlds between the fiat world and the stablecoin world. And one of the things we're focused on at ARP Digital is OTC and payments. And we actually got to payments by extending out the OTC product that we have. So if you think about it and the value that stablecoins actually provide, and we see this especially being based out of the region that has connectivity with a lot of emerging markets and developed markets as well. You know, crypto trading volumes here continue to decline, to be honest. It's a small market for it. But stablecoin on-ramping volumes continue to increase. And it's for a reason. It's because people are using it to settle. They're using it as a settlement infrastructure and a tool. And so we recognize that. And actually, the first people who started using it are like agency brokers here or crypto exchanges here who act on a purely agency basis and don't take any principal risk, right? They'd be reliant on external market makers, liquidity providers globally. And so they'll end up having local deposits, and they'll need to settle locally, globally with counterparties. And those counterparties are fine accepting crypto because, one, they're normalized by it, they can have it on their balance sheet, they're okay with it. And so you start off seeing the crypto firms first using it as a means of settlement, and then it extends down the client and the value chain. And what we're seeing now is, you know, not just crypto firms using it for settlement. We're seeing SMEs using it. We're seeing import and export companies using it, and they see massive advantages. Like if you just take the real estate market in UAE, for example. If you start from the construct that there is, Dubai and the UAE has very favorable commercial, regulatory, tax environments that attract multinationals. And by that definition, that means there's a lot of non-AED denominated capital that's going to be repatriated and is already being repatriated to the UAE. That capital needs to be redenominated in AED, and the bankability of that capital is delayed because it's not so easy to go set up a bank account here to get everybody's ID and all that. In the meantime, you have kind of on-rampers in these type of, in these countries that are quite easy to access, and they'll be able to get stables. Once they have access to stables, if they can spend it to get critical infrastructure that they need to move, like property here, then that's something that is beneficial for everyone. The developer is happy because he's able to activate a client segment that he didn't have before. Client is happy because he's able to buy property or infrastructure in a very demanding market, which is Dubai real estate, which has a lot of competition for it. And service providers are providing that value. So I think we can go across the spectrum and we see different use cases for different types of clients. But it's clear that stablecoins are being used more and more from both the wholesale side and the merchant acceptance side. And I think it's just going to become more mainstream.
Thank you, Abdullah. Very promising. Ross, on your side, Ripple has announced the RLUSD stablecoin at late 2024. Can you tell us more about your intention there and what trade-focused asset managers and originators should be aware of around the RLUSD?
Yeah, absolutely. Thanks, Andre. So, Ripple's been a company working in digital asset infrastructure for well over a decade now. I think we were founded in 2013, so very early in working on enterprise blockchain use cases, and in particular working with financial institutions. And our historical product set has predominantly been built around the payment space. So we have built out a payments network that is processing many millions of transactions at many billions of dollars value every year. And I think reflecting some of what Abdullah said, we've seen over the last 3 to 4 years in particular a huge uptake in the relevance of stablecoins within that, and in particular institutions that we work with wanting to fund payments with stablecoins or pay out in stablecoins, particularly the former. And that sort of led to us building out a huge business in the stablecoin world. We have been one of the major users of other US dollar stablecoins, the major US dollar stablecoins in the past. And looking at that, that's a piece of the value chain that we think we can further contribute to. And we know that there's going to be multiple US dollar stablecoins in the future. There will be multiple providers. There will be stablecoins that are suitable for different purposes. And looking at that and the needs of our customers, last year we adopted a program to launch RLUSD, so our own US dollar stablecoin. It's issued out of a bank charter license in NYDFS. So we see that as really the gold standard in the US regulatory regime, where it is actually prudentially regulated as opposed to just being regulated by money transmitter licenses. So we see that as much more palatable to the institutional space. And so we're really looking at RLUSD as a way to better enable stablecoins between or by institutions. And we see we have a huge strategic benefit or advantage in that space, having a very large and rapidly growing payments network. So we've already strategically inserted RLUSD within our end-to-end sort of payments network, enabling that. We're working on cases in the capital markets and distribution to enable that, and obviously looking at the trade space and how to better enable it. I think the trade can, as we reflected before, there are huge benefits to be received from stablecoins, in particular changing the risk profile, etc., of transactions themselves. So we're looking at that RLUSD was launched last December, so it's very early stage. It's grown to over $350 million cap, I think, and I think the target is to be a sort of top 5 US dollar stablecoin by the end of the year, but very much focused on institutional use cases. And that isn't just about saying that, it's about having the distribution network to achieve that. It's about having the use cases built within the network and enabled that can make that happen. And that's really the lean into the trade space as well.
So being regulated as you are, for the stablecoin at least, is a key differentiator. So
I think the regulatory basis is a key differentiator, and the experience in both the traditional financial institution and payment space crossed with the digital asset space is a key differentiator.
Okay, thank you, Ross. Great to have you with us. Indeed, first time I can welcome Ripple, which I followed for a decade after having left Swift. Quite natural to follow up the evolution of Ripple. So great to have you with us. Ashwin, what's your take on the use of stablecoins in trade?
I mean, echo a lot of what has been said in this panel, the previous one, right? Speed and cost, very apparent. Speed being very, very important differentiator. That's becoming very apparent. And as a function of speed, you're essentially getting better cost, right? Because your FX spreads reduce. And this has become a pivotal selling point, right, of the whole stablecoin payment solution. But what doesn't get the light as much is the whole visibility and traceability, because I think speed and cost are so obvious and such important aspects that the other part, especially for SMEs. I mean, we had this research done and we were saying we got to a number. I don't remember the number. About billions of dollars of payments that just gets lost in the correspondent banking network, just gets lost or delayed to a point where it's crippling. I mean, for an SME who have, their capital is very, very little, losing your payments in the system is crippling, right? I think that is an aspect that is also important when we actually speak to clients, when we tell SMEs or even large corporates, this is an element that captures their attention as well. Of course, as I said, speed and cost being very obvious, but this seems to drive home the point sometimes.
Thank you. Ashwin, Santos, on your side, you're working for XDC network, which is a layer 1 network. Billy will tell us more about the stablecoin progress that has been made. But on your side, from an XDC payments point of view, what is your take, and how do you see XDC as a layer 1 supporting stablecoins?
So just to give you a brief introduction about what XDC payment is all about, what does XDC payment offer, and then going back and relating to what Andrew asked in terms of how we see stablecoin. So under XDC payments, we have different modules. Core ones of them is liquidity provisioning. We have custody services. We have on-ramp, off-ramp solutioning. We have an enterprise and a white label solutioning for cross-border payments, which is compliant with ISO 20 or 22 messaging. And we have an entire stack for XDC tokens. So the XDC network native token is XDC. And as of today, under XDC payments, XDC token can be off-ramped into about 79 countries, into about 29 gift cards, into mobile top-ups. All of these elements are live today. This entire thing comprises under XDC for payments. Stablecoin being one of the closest and the favorite when it comes to payment. Once you have decided that you want to focus on payments, the way XDC's focus on stablecoin is to natively get pegged with the largest circulating stablecoins, to the likes of USDT, USDC, where all the transaction happens on chain, and to give you use. And the use cases of this would be definitely on the trade side, which we all are talking about, where exporter gets real-time funding using on-chain XDC's funding given to him, or it could be for remittances, it could be for cross-border payments, it could be for financial inclusion, which is to be given to someone who doesn't have a bank but just has a wallet. These are all utilities and use cases within the payment division of XDC that are being rolled out. Another precise use case for the stablecoin use case that XDC is focusing on is getting pegged with AUDD in Australia, okay? Getting pegged with AUDD in Australia and getting listed in Philippines. So the entire corridor and the rails becomes of XDC exclusively, where a user comes in Australian dollars and goes out in Filipino peso. But in between, the transaction is dealt using XDC rails. So that's the focus, and that's a precise use case that currently is being focused on and is being executed at XDC using stablecoins.
Thank you. And Billy, on your side, from a foundation perspective, what is your view on XDC supporting stablecoin issuers?
Yeah, well, stablecoin, for us, we look at it as really the on-ramp into the ecosystem. And whether you're operating in trade finance or you're operating within DeFi, you need to have those on-ramps here. You need to have the ability to bring dollars in. So, for us, we've been focused on bringing the digital USDC onto the network. We've done that by building a bridge to a Circle standard where we have a wrapped version of that. And now we're really looking at how we can start to build, the liquidity on the network itself. And a lot of that actually goes into really what Santosh is ultimately doing, and really trying to bring ultimately, the ability to have native USDC on chain, and working to be able to really bring institutions on by enabling them to go easily from fiat as an on-ramp into a digital asset. And I think that's really the lifeblood of what you need to do in terms of really driving trade and payments. And as it relates to businesses, we've always focused on trade finance. Really from the beginning, that's really been our lifeblood. And a lot of that has really been about all boats rising. And I think, what you need to really do is bring working capital to businesses. You're doing that, right? And this is something that you really need stables in order to do.
So offering indeed our panelists on the previous panel focused on origination, the choice to use multiple stable coins, the one they believe they need, through the tokenization of the end-to-end transaction on XDC, basically. Yeah.
Yes, and really USDC or Circle has enabled the ability to do this through their bridge at this point, but obviously we would be and are looking at numerous stable coins that we're able to bring on. And as it's been mentioned, there's different use cases for different stable coins. And so in many cases, the more you have, the more liquidity you're bringing on, and the greater opportunity is for SMEs.
Yep. Santosh, yes, please.
Wanted to add, a point to what Billy mentioned, and what you had asked. So that's also an advantage to a network like XDC, where we would work with like multiple, stable coins and not be, stuck to one. It's agnostic of stable coins, because it's just not about, using with stable coin. It also relates to the liquidity aspect for that stable coin, the jurisdictions, the compliance angle in terms of how compliant that country is regulated with that stable coin when it comes to collection and disbursement both. So that's an advantage with XDC as a network has, not being rigid or not being completely tied up just to one particular token. It's agnostic of stable coins. It could work with USDT, it could work with AUDD, which is in Australia, and just still get the entire payment rails completed. And for multiple use cases, it could be for trade, it could be for B2B, or it could be for even P2P.
Yeah. Okay, so very open approach to this market. And indeed, I think going forward, it's all about liquidity and getting the liquidity where it needs to be, rather than trying to be the layer one with more messages than the other layer one, actually.
Because see, most of the times we always speak about cash flow management, which we are solving in for the SMEs. What's the point if the SME is stuck with tokens and does not have fiat into his account, right?
Yeah.
So eventually, it's all about liquidity.
Yeah. And thanks to ERP Digital and others being able to bridge the old world, the fiat world, with the tokenized world. I played with an AI tool and with Grok, actually, whichever, it could be ChatGPT, and playing about to get some feedback on the view of the AI tool on stable coins. And one of the feedback was, and I will ask Ross and Abdullah to comment, stable coins operate in a patchwork of global regulations. We heard it from Andrea. Some countries embrace them, others ban them, creating uncertainty for B2B use. So how do you go about this, Ross, at Ripple? because at the end of the day, you want to scale adoption, but you have all those regulators having different views.
Yeah, so I mean, I think first of all, it's probably worth acknowledging there is a huge amount of stablecoins used in trade already, and it's predominantly being driven by accessibility, and it's predominantly driven by those who don't have great access to US dollar facilities or US dollar itself today. We think at Ripple that will change over time. I think the predominant drivers will be the basics, which was mentioned before in terms of speed, cheaper, faster. But more so will be driven by, again, the certainty and transparency that was mentioned before. The fact that you don't just prove that you sent a payment, you can prove that the payment was delivered. That is transformationally different to anything possible in the financial or TradFi world today. And so we think that those benefits will are coming to light. We think it will move effectively up the chain, and we think a high level of regulation and hitting those high regulatory bars are critical, and hence our decision to issue out of an NYDFS trust as opposed to many other regulatory structures out there is important. Embracing the nexus with the US regulatory system as opposed to skirting it, I think is important. And I think we're actively working with the different regulatory environments around the world. It is a genuinely difficult balance to be regulatory compliant, but interoperable and seamless experience for users. Right? If you look at the MiCA regulations, etc., it sounds simple enough, right, in terms of meeting European laws with the US issued stablecoin, but they want segregated reserves as an example. Now, you can have your token interoperable, but it's not interoperable if your reserves are not interoperable. So we're actively solving those challenges. We're working with the different regulatory environments around the world. There's still some significant progress to be made in many jurisdictions, including Australia, as an example, where further clarity is needed. But as that clarity is seen, we're working with both the local regulatory authorities as well as partners in those jurisdictions to attain the highest regulatory bar that we can, and that will provide the most benefit and value to our target market, which is the institutional space.
Okay, thank you, Ross. Abdullah, on your side, how do you see those regulations helping you or being an obstacle? How do you leverage those if possible?
I mean, I think it's critical for us. Regulation has really allowed us to do a few things. One, it's allowed us to set up the right infrastructure and the right piping. And without that, you won't be able to service any of the demand. You won't be able to get liquidity. You won't be able to have a robust product. So one, even though stablecoins are transformational and kind of the risk that transferring with stablecoins drastically reduce reliance on regular networks, you still need an off-ramp capability, and that requires dependence on banks, right? So you need to be banking with top-tier banks to be able to have that access. It also gives you access to the right liquidity, the right service providers. Service providers become very skeptical working with counterparties that are not regulated. And it also takes a long time to build brand, to be able to access funding lines, to be able to have working capital facilities, to do instant settlement capabilities, which is what the entire promise of stablecoins are, right? Because if a merchant or an SME has stablecoins in his wallet and he can't spend it, then it's kind of obsolete. So you need to have something that allows you to have merchant acceptance, but actually have fiat in your bank account that's spendable on your OPEX or your CAPEX. So that's the product we developed. The other thing that regulation allows you to do, it holds you at a very high bar in creating your business and creating the foundation layer to allow you to scale, right? So if I think about all of these guys here with the payment networks that they've developed, I'm sure one of the very important parameters that they consider is who's their payout partners, who's their pay-in partners. And that would be a function of what's the right regulation, what's the right bankability, and all that comes with, I don't want to say appeasing, but having the right framework in place that de-risks you as a business, and by that definition gives you greater capabilities and greater optionality. So that's what it's allowed us to do.
Thank you. Abdullah. Ashwin, on your side, you're advising clients on those topics. What has been your what is your current perspective on those regulations for stablecoins?
No, I echo what was said, right? Regulations gives a certain degree of legitimacy and a bedrock on which these use cases, these transactions can be facilitated and then kind of exported. Because for institutions especially, right? Regulations, I mean, institutions are risk averse. So the regulations create that kind of a platform for them to experiment and the certainty of payments, or at least a fail-safe, is what they provide. Of course, are regulations there yet? No, they're evolving, but at least one thing is very certain, that they're evolving in the right direction, right? Of course, some regulations are not as conducive to growth of stablecoins, but having that, broad-based regulations across different countries is the first step, because that sets the platform for you to broadcast this payment rail as really legitimate and scalable. And also the other way to think about this is, regulations specific to payments, especially when it comes to payments, regulations become very heavy, right? There are a lot of use cases also. So you kind of, get your clients to get used to, the whole tokenization aspect, right? When certain regulations in payments is not allowed for it, right, in certain countries, but there are other use cases, right? So that is the way also to drive adoption, is to, they said, like last panel was all about digitization of documents, right? Tokenize it. So that there are other alternatives to adoption when your regulation is prohibitive of payments, right? So it's more about, I mean, if you step out of this room and when you talk to clients, right, we talk to different rates of clients, the lack of know-how on what stable coins are is quite striking. We did several conversations, and there's this inherent association of stable coins to crypto, and all that crypto has facilitated on the illegal transaction side, the speculative nature of things. It's that basic. So you're talking of regulations facilitating, seamless payments, but clients on different varying spectrums are unable to distinguish between stable coins and crypto. So there's a huge learning curve that has to be kind of the industry, all the facilitators to kind of push this into the space, and that is through use cases. And when payments plus the digitization of documents and trade finance is the great intersection, right? But we are a long way away from that. So it's about taking small steps while the regulators also kind of align. And that's happening, as you can see.
Yeah, it is happening, and indeed, the adoption by top banks of new technologies, Ripple, ERP Digital, or layer ones like XDC, backed by regulation, will legitimize the business. So it's a matter of time, but I think the train has left the station on that side. It is happening today. The top banks are just a bit slower because they need double confirmation and validation with regulators that what they plan to do will be okay, of course.
It's definitely a Kodak moment. The Kodak moment has passed.
Yeah.
It's just that some people don't recognize it.
Yeah. Some people need more time sometimes, yes. Santosh, on your side, for XDC payment, what kind of partnerships are you looking to build? You have here corporates, non-bank lenders, asset managers, or service providers like ERP Digital. What kind of partnerships are in the short term you looking to build?
So, I mean, as you said, I mean, you covered up like the entire partnership, the likes of ARP Digital, the asset managers, on-ramp, off-ramp partners, in multiple jurisdictions, corporates, all of these are partnerships. And the objective and the reason behind to do this kind of partnership is it's a highly regulated business, right? I mean, the earlier question was all about, what obstacles do we see regulations? From the other side, it's not about obstacles, it's about shielding, right? It's also, obstacle also can be seen as a shield from other side, right? To regulate the entire business, the money, the tokens, everything. And to do this business, you require certain licenses in every jurisdictions. And therefore, partnership comes in very key instead of having to apply your own licenses to get the right amount of regulatory nods from the regulators. Partnership acts as a key not only with asset managers, but with also regulators, with also existingly licensed entities whom we can leverage, whom we can thrive on and use their licenses and do business in that particular jurisdiction. So that's why partnership, not only from a client perspective, even from a regulatory perspective, it comes in very handy for payment as a business.
Yeah. And Ross, on your side, for the distribution of RLUSD, what kind of partnerships are you looking to build in the short term?
Well, I think we've got to find the right access points into markets. So if we look at trade, for instance, we can't directly interface and service everyone participating within trade, right? It's just too huge. So it's about going through the right networks and access points. That probably starts with sort of trade finance brokers and that sort of space, and accessing through the markets on there. More broadly, though, for the success of a stablecoin like RLUSD, I always think about it in three different areas really need to come together. The first one is sort of availability, and that's just the foundation. So it's not just about distribution. First, you've got to get your reserve bank, your transactional banks, the tooling, the compliance, and reg tech across the top of it, right? To even have something to distribute. Then you need the accessibility in that distribution. You need people to be able to access it. I can convince you it's the most regulated, best, awesomest stablecoin in the world, but if you can't access it, you're not going to use it. And then third, and importantly, is that utility and use case. So we need partnerships across that. It's going to drive differentiated use cases, differentiated for stablecoins versus fiat flowing through the banks, differentiated in our case around RLUSD and our broader product set. So that's how we look at partnerships more broadly, and all three of those areas are key for success.
Okay, thank you. So more work going forward to scale adoption besides the regulatory dimension. And Abdullah, on your side, how do you organize your go-to-market as a off-ramp, on-ramp partner?
For us, the most important thing is understanding the problem set and the challenge deeply. And then once you do that, it's really all about the messaging and the delivery to clients. Like, I'll give you an example. One of the products that we've developed was merchant acceptance of crypto by abstracting away the blockchain complexities and then us settling fiat into the merchant's bank account. And that opens up the market because merchants don't want to deal with all of the wallet infrastructure, the security. They just want to get fiat in their bank account in different currencies. So one of the approach for kind of this product development was, okay, now we have this great product, let's just go sell it to everyone. And one of the things that we heard was, okay, it works well for equity brokers or FX brokers, but we never really understood why, right? Because if you have crypto and you've gone through the trouble of on-ramping to crypto, why would you go and trade FX? You probably want to trade crypto. The volatility is better, it's better for trends, better for momentum. Like if you're a trader, that's what you look for. And then, and so our communication and our messaging was not the right messaging for those clients, because it's like, okay, we have this available and your clients can now use it. And then when you actually understand the use case, which is a lot of these clients, trade leverage products, they want to top up their margin and they want to avoid liquidation risks. And the reason liquidation risks exist is because whenever they fund in their equity brokerage account or their FX brokerage account, it takes a while for the cash settlement cycle to be reflected in their balance. And the market can move against them and they'll get liquidated. So they get pissed off at the exchange. So when you go about it that way, fully understand what the problem set is, then even people who don't understand why they need the solution, you can just deliver the message in a way where they recognize this problem exists, and then they recognize that this is a solution that will allow them to captivate their clients better, it will increase client satisfaction, it will give them more robust product, right? More robust optionalities for different client segments. And what we found is actually this client segment is probably one of the most robust client segments for merchant acceptance, whereas in the beginning it was the worst, right? And that's fully a function of understanding the go-to-market and the messaging for it. So I think that's critical in understanding the root issue and how to solve it.
Yeah, the famous depegging risk as well of stable coins that the regulators are looking for. What is your reaction, Abdullah, to, I've seen MasterCard, I'm sure Visa is doing the same, also taking a position in this stablecoin market. Would that help on the retail side as well?
I think definitely they're probably thinking about, how do they not cannibalize their existing business by introducing stable coins, but they, at the end of the day, they have a network of all of the participants that people who are building out payment networks with stable coins need, right? And so it's a function of prioritizing which products that they're going to launch and where they can have efficiency gains and where they're going to have cannibalism, right? And I think over time is, using Visa or MasterCard for cross-border payments is just not that efficient, right? So it's better off using a better, more efficient tool and settlement structure like stablecoins. So I think it would be advantageous for them to not resist the change and to try and incorporate themselves and to leverage their existing distribution network that has allowed them to build the capabilities to where they are now. And then they can always use that to develop the product, upgrade the product, find new ways to be competitive in the market. And I think that's a good idea for them.
Yeah. Okay. Fascinating. New players, small players, but also big players involved. And indeed some geopolitics as well, because indeed today the whole market is USD focused in terms of volume, 200 plus billion dollars on stable coins today, certainly if you count Tether and Circle, whereas Europe is lagging. So indeed, I've seen some articles from lawyers talking about the geopolitics of stable coins. And I think a need for European regulators to catch up and to not see that as just a technology innovation, but really a way to support monetary policy at the end of the day. So more for us to discuss on this going forward. Do you accept, all of you, that some of the people in the ocean catch up with you for more insights and potentially pilot transactions on the trade side? Is that okay for all of you? Yeah, XDC, I know it will be okay. Yeah, okay, very good. Thanks a lot to all of you. And let's move on to the next panel. Thank you.
Good afternoon. This is the final panel, I believe. Yeah, we won't take up too much of your time. I'll start very quickly. My name is Angus O'Callaghan. I'm Head of Trading and Markets at XDC.
Thank you for having us. David Nudger, Head of Tokenization at Fasinara Capital. So Fasinara is a real-world asset manager focused on private credit. Alongside that, we'd also have a digital asset fund focused on crypto liquidity provision with a market-neutral hedge fund.
Hi everyone, so my name is Luc Falampin. I'm the CEO of Tokeny. So for 7 years now, we help financial institutions and corporate to tokenize their assets. So basically issuance, lifecycle management and distribution of these tokenized assets. So we are the technology provider in white label, so we are in the back of many of the projects you've heard about, but quite discreet.
Hi everyone, my name is Jude Frederick. I'm the business development director for Uniwire. Uniwire is part of a portfolio of 40 different portfolio companies that build infrastructure in the crypto and fintech space. I focus predominantly on crypto payment infrastructure, and UI will be supporting a lot of the tokenization and stablecoin developments for the future of finance.
Hello, everybody. My name is Ian. I'm head of markets and partnership for XDC. I started my career in this space as a lawyer, then transitioned to become an entrepreneur in this space. And I'm also leading one of the largest communities in the RLUSD space named SDG3, which encompasses many of the organizations that operates in this space.
So, launching tokenized products. Where are we at, Steve? We've been trying this for almost a year now, right? How do we do it? What's the hurdles? How do we get this done?
So I think in terms of launching a tokenized product, it's not very difficult. You see this guy, his name is Luke. You just call him and ask him, can you tokenize my product? And it's pretty simple. There's people that are doing it for years. They have the standards, and there's compliance in place and everything. Tokenization itself is not an issue. I think that the issue has always been the use case, the liquidity. And I think what happened in the last couple of years with stablecoin, this was related to the previous panel before us, is that when stablecoin came in and stablecoin became the product market fit for the entire industry, that's what it is. It basically opened the door for tokenization of products. Because once you have a stablecoin, once you hold a stablecoin, what the next thing you want to do? You want to get some yield over this stablecoin. And the only way to get yield is by investing in investable products. And those products, they cannot exist on a different ecosystem. You cannot invest in Fidelity Fund if it exists on the New York Stock Exchange or the NASDAQ with a stablecoin. The NASDAQ and the New York Stock Exchange currently do not accept stablecoins. So what do? You need those funds to be digitized. Once they're digitized, then you can invest with a stablecoin. The settlement happens very fast, and the emergence of stablecoins basically create the demand for yield-bearing products, such as money market fund. And as you know, Angus, at XDC, we tokenize Fidelity, Aberdeen, State Street, and BlackRock. They are currently on XDC. If you go to the XDC Explorer, you can actually see those money market funds reflected on the XDC chain. We did it through a regulated entity named Archax in the UK, which is regulated by the FCA. And those money market funds can go to back stable coins or to offer yield to stable coins holders.
So before I go to David, Luke, what's your comment? Where's the hurdles? Why is everyone struggling with this? We've been trying to do this 7-8 years myself. Z is the same age. XDC is the same age, and you've been trying as well. Tell me.
Tokeny as well is the same age. We started end of 2017. I think it's because there is tokenization and tokenization. It's like creating a website. What does it mean? You can create your landing page or you can create Facebook. It's totally different things, right? What we see today on the market is simple tokens most of the time. ERC20 tokens, like crypto-like tokens. So even if they are supposed to be backed by some real-world asset or securities, they are simple tokens. So they are blocked in a wallet somewhere or on an exchange or custody solutions or whatever, usually a distributor, and you cannot do anything with these tokens. Why? Because if they leave this custody wallet, there is no compliance, there is no control anymore, so nobody can use these tokens. So why you tokenize? For marketing. So unfortunately, a lot of projects about tokenizations are failures because they tokenized and nobody can use their tokens. What we've done is a bit different, is to bring compliance and control within the token itself. So we created and open sourced a token standard called TRX, ERC3643. So it's a real ERC now, so it's a terrible name, but we didn't choose a number. And with these tokens, so the tokens are permission, so they can go everywhere. You can use DeFi protocols, you can do everything you want, but under the control of the issuer or its agents, like the fund administrators. So you don't need to have one token per distributor. You have one single token representing your assets, it can be native, and then you activate distribution channels. And all of these distribution channels move the same token. So we have one ledger based on blockchain data,
and not sub-ledgers like we have today in traditional finances that we are unfortunately replicating on-chain. So we think it's the next move. It's not about creating tokens agogo and making sure that it's traded in crypto exchanges. It's about bringing good assets and bringing compliance, permissioning in the right way to make sure it's interoperable and that you can leverage this on the blockchain networks.
Makes absolute perfect sense. I'm going to pass over to David before we go to G. David, what's your view here?
Yeah, wholeheartedly agree with the rest of the panel here. I think one was going to award for the number of times stablecoins have been mentioned here. So picking up on this, what happens when you take the most popular real-world asset out there, which is the US dollar, and then you tokenize it, you put it on digital rails, you allow it to trade 24/7 instantaneously, accessible to the whole world. All of a sudden it gets mass adoption. And we need to use that as an example because to Luke's point, we can get the structures in place, we can get the compliance in place, but if somebody doesn't want something, tokenization isn't going to help you with this. If I pick a random building here and decide to fractionalize a component of it and offer it on Rails, no one's going to buy it. The tokenization isn't going to help you. So where we're really focused on is firstly, what is it that on-chain users will be demanding? Like what's the benefit versus actually purchasing this product, interacting with it in TradFi Rails? What's unique and differentiated? And then to the second point is then how can we make it into a regulated, compliant, operationally resilient structure that can be distributed globally? And that's really what we're focused on.
Makes absolute perfect sense. And G, you've worked in stablecoins, the infrastructure for many a year. What's your view, sir?
Yeah, well, just from our perspective, we're always thinking about when you're looking at tokenizing products, you need to think about the infrastructure that sits behind that. And we know that it's got to be highly scalable. And one of the kind of core things that we're focused on over at Uniwire is enabling that scalable infrastructure. It's not just about creating the asset itself, but it's how do you then distribute this asset? How is that asset then distributed across, for example, like multi-chains? So, this is one of the things that we're focused on. Straight out the gate, our offering is multi-chain. Further to that as well, at the same time, you've also got to consider, well, when the end users of these particular tokenized assets, we're looking from the perspective of the regulatory example there. How will that sit depending on the jurisdiction that this particular asset's in? Because you may well be looking at a scenario whereby the property rules of ownership in this specific jurisdiction do not comply with another. So we need platforms, we need infrastructure that can facilitate that. And these are the things that Uniwire have been working on, heart and soul, since our inception. I'll just add to that further that as the likes of BlackRock, the likes of these traditional finance players, want to move further into this space, they're going to rely further on this type of infrastructure, which isn't their game. So the likes of Uniwire will spend some time building this out and that enabling them so that they can access this space rapidly.
100%, as long as it's built on XDC. But from an XDC perspective, we only work with regulated entities, right? So this is why it's BlackRock, State Street, Securitize, Aberdeen Standard Life, Archax, SDX. There's news to come, which is not going to be announced right now, but we're working with the most highly regulated players globally, and that's regulation is coming. Some people made a quick buck during the fun time, but regulation is coming, and if you're not regulated in the right places and you're playing in the wrong park, you'll get hurt. It's just a matter of time. And that's why XDC only work with regulated players. So over to me to wrap up. We'll keep you, listen, I'm sure people want to catch the sunset. So listen, thank you so much for everyone coming. Thank you very much to all our panelists. Thank you to Andre for organizing this. Pleasure to meet you. We'll be around, so please come meet us afterwards if you like. Thank you.
We have a final topic to cover. Moving on, I'd like to welcome Sajid of Fazanara to tell us about the asset management side of tokenization and investment products. Sajid, over to you.
Thank you so much. Well, I will keep this super short and brief, given that we've all been sitting and listening to some riveting discussion points today. And of course, we can catch up over the networking session. But we've touched upon a number of topics today. We hear regulations coming for a while. Regulators globally are slow behind the scenes. They don't necessarily understand the product. They're not technologists. They're not from an IT background. So let alone do they understand tokenization in its own right, but even as a product. But the mindset of trying to regulate something which ultimately is going to retail investor protection. Big boys like ourselves, we are an FCA regulated asset manager, managing 4.5 billion in excess of in private credit, as David stated, and a digital assets fund as well. Now, at the same point in time, we've had very active dialogues with the FCA, and it's clear that they're not trying to slap us around the head for touching digital assets. They want to understand, what are we touching? What is this thing that's making excess money for you guys? How are you doing this? How is the retail guy on the street, the Joe Blogs, the Aunt May sitting in a valley somewhere? Are you selling lemons to the orphans of the world? That's where they're really trying to make sure that that the actions as a community, as the investment management industry, the retail investors protected. And they've seen from Twitter feeds or Instagram, who wants to, Bitcoin bros, everyone's become millionaire overnight, and some people have, to be quite frank. I mean, these people put a lot of their asset and the checks that they got from the government in the US, the Fed checks, put it into Bitcoin, and actually are now sitting on a decent wad of cash. At the same point in time, others have also lost a lot of money as well. So you can see from a regulator standpoint, what is my language, but what is this asset class? We don't understand it. There's people all over the world looking at it, and we've got no control. For example, in the UK, we have financial promotion rules, and in many, many countries, you've got the ability to market and distribute a financial product is regulated for a reason. The message that you're putting out there needs to be true and accurate and not misleading. You can't say this is.
So when you say that, when it comes to FinProm in the UK,
yep.
How does Fazanara, how do they abide by that?
Well, look, the rules apply whether it's token, crypto, or debt instruments. The same rules are there. You have to ensure that it's not going to retail guys. You need to ensure that the information there is not misleading. Now, when we are all using LinkedIn, Telegram, WhatsApp, can you imagine how many communities there's actually a financial inducement happening? It's happening it's on our doorsteps right now. I'm sure if you open our phones, you open up your Telegram chats, I can assure you, if you show that to a regulator, they'll say, sorry, buddy, that's financial information. So going to your point, how do we deal with this? As a firm, commercially, we want to have mass exposure. We want everyone to know about Fazanara, our exciting products. With my chief compliance officer hat on, I don't want that. And so, best, we're happy with LinkedIn and with standard compliance goes all over it. David puts out a blog, right? This is a real example. Next thing, it comes back, and all the salient points that David wants to put out to drum up interest has been scratched by a compliance team.
You put a buy button on your website, so it's FinProm.
Yeah, pretty much so.
Just a buy button, and it's FinProm.
We've got, when we launched our Tokenized money market fund, so there's always this construct of reverse solicitation, if you guys may have heard of that. Basically, I'm not telling you about what my products are, but I'm telling you about a strategy, and if you're interested in a bit more about a strategy, then contact me. And I can assure you, and we had this register your interest tab. So it's ultimately going towards supporting reverse solicitation. And before you could even get to that page, you had to confirm that you were a professional accredited investor. Well, FCA likes to have a look around and said, hang on a minute, guys. What have you done to ensure that those who are actually clicking on are actually professional investors and it's not just Joe Blogs on the street? And that becomes a challenge. So hence why the various adoption of crypto and digital assets truly for asset managers. I mean, we Faznara Capital, we are quite innovative in its own right. Fintech lending, and we can touch upon many other points that we discussed today in greater detail. But much of this is our bread and butter. But one question that I do have is we talk about the benefits of tokenization. However, and this is a moral hazard and a selfish act, we want to make returns for investors. Tokenization, let's work on the assumption, it cuts out the inefficiencies, the friction points. Who actually benefits from that? Does the cost of funding that as a done company, when they buy these goods for their supply and content, are they charging 25% or now charging 20%? Because you have to think about it, we're talking about real world economy, right? Real world assets goes all the way down to the chain. Now, I can assure you that my investors still want to be earning 12%. They're not saying to me, well done, guys, you've made this so efficient, and I'm happy to accept 10%. So I've still got pressures there. So I need to make my margins. Downstream, the duns, the tokenized, the originators, they've still got pressures as well because my cost of funding is still pretty much there. So we talk about the benefits of tokenization, and there are heaps of benefits out there. But for the real economy, sometimes you do question or wonder, does this benefit get passed on to the end consumer? Question for you. Go for it.
Right. So if the Fed rate is 5%,
yep,
why are you able to get stablecoin yield at 15% plus? Where is that margin coming from a risk perspective? Who's the counterparty? Who's the counterparty risk there?
Also, if you understand private credit, so we spoke earlier about banks retreating from trade finance, and there's been various issues in the sector, from commodity fraud, double funding of invoices, etc., etc. And the banks don't like that type of asset on their balance sheet anymore. So you've got to, when you compare Fed rate, think of what that's bank's risk tolerance levels these days. Then you come to fund managers like ourselves who take a bit more risk. So in a credit stack, think of the ultra low risk at the top end, where there's so much credit enhancement, so much protection in the liquidity liquid stack that your money's pretty much like a T-bill. And then when you take the mezz piece, you take another layer down, and that's your risk profile. So a higher risk, higher reward. So from private credit, and at Faznara, we've been managing receivables fund for over 12 years, no down months for over 12 years, and consistently returning 9 to 10% in USD to our LPs. So, and our traditional LPs are your pension funds, insurance companies, institutions. Where we are looking also in the tokenization space is actually say, hang on, we've got these LPs, these are our good LPs. This is what we've been dealing with them all the time, but we're now seeing this big capital out there in the DeFi space. There's foundations, there's protocols, there are actually players who've got real capital. Do they have a need for an asset which is stable return, getting 10, 12%? Yes, is the answer there. Because T-bills are great, it was great marketing, everyone liked the hype of it, but we actually want real yield in there. So we are now devising a product. At the end of the day, private credit in the risks and the returns that we're getting ultimately is substantiated by the fact that the underlying asset is not a self-liquidating asset in the public markets on a 24/7 basis. So you have to, if you want to have something that can be liquidated on an atomic settlement basis, you're not going to be getting 15%.
But there are mechanisms, and we'll have some things in short order to talk about, because we are devising a product that has a liquidity sleeve alongside private credit. Otherwise, the DeFi community, it doesn't work for them, because whatever they hold, it needs to be liquidated much more frequently than traditional funds world, whereby you've got an administrator that runs a process. The NAV comes out at the end of the month, 3 weeks delay for getting that. So we've got massive time lag already. The DeFi world and all the parties, we work in real time now, right? So transparency and data.
That doesn't work anymore. Yeah.
No,
It just doesn't. So given that it's the TFD initiative, so you're going to create a transfer of value product for trade finance. Is that what you're saying?
Not just trade finance, private credit.
Okay.
Thank you, guys. And yes, take a view of the sunset over there. I'm not sure whether there's any drinks here or not, but look, we're around, and you can get myself and David's contact details from the team. But look, massive pleasure to be speaking to you guys, and thank you so much for arranging today.
Thank you, Sajid. Looking forward to your next developments. Looking forward to your next developments. I'd like to thank all of you speakers and attendees for joining us today. We are hosting our now, so networking is open. Drinks and thanks again. See you at the next.